Have you ever wondered how options trading works? Well, you're in the right place. Options trading is a fascinating and potentially profitable type of derivative trading. Now you might be asking, what is derivative trading? Simply put, a derivative is a financial contract that derives its value from an underlying asset. In the case of options trading, this contract gives the buyer the right, but not the obligation, to buy or sell this asset at a specific price on or before a certain date. Think of it as a reservation at your favorite restaurant. You have the right to that table, but you can choose not to go, and all you lose is the reservation fee. That's the essence of options trading. It provides flexibility and potential profit, all while managing risk. Sounds interesting, right? But let's delve deeper. To understand options trading, you need to get familiar with two key terms, calls and puts. These are the fundamental elements that form the basis of all options trading strategies. Let's start with the call option. It's like a reservation at your favorite restaurant. You make a reservation for a table, but you're not obligated to show up and dine. Similarly, a call option is an agreement that gives an investor the right, but not the obligation, to buy a stock, bond, commodity, or other instrument at a specified price within a specific time period. This specified price is known as the strike price, and the time period is known as the expiration date. If you think the price of the asset will go up before the expiration date, you might buy a call option. Now let's jump to the put option. Suppose you're a farmer who grows apples. You're worried that the price of apples might drop before the harvest season, so you enter into an agreement that allows you to sell your apples at a fixed price, ensuring you'll get your expected profit even if the market price plummets. This is the underlying concept of a put option. In finance, a put option is a contract that gives the owner the right, but not the obligation, to sell a certain quantity of an underlying security at a specified price before the option's expiration date. If you believe the price of the asset will go down before the expiration date, you might buy a put option. In essence, buying a call option means betting on the price to rise, while buying a put option means betting on the price to fall. It's a bit like a game of chance, but with careful analysis and strategic planning, you can tilt the odds in your favor. Calls and puts are the building blocks of options trading. Now let's see how we can use them. Now that we know what calls and puts are, let's explore what it means to write options. When we talk about writing options, we're referring to the act of creating an options contract and selling it to an interested buyer. In essence, the writer, that is you, are agreeing to buy or sell an asset at a particular price, known as the strike price, within a specified time frame. Think of it this way. If you're writing a call option, you're offering someone the right to buy an asset from you at a later date at a pre-agreed price. On the flip side, if you're writing a put option, you're offering someone the right to sell an asset to you. But why would you do this? Well, there are two main reasons. First, you can generate income from the premiums that buyers pay for the options you write. Second, you can create a hedge against potential losses in your investment portfolio. Let's break it down a bit. When you write an option, you receive a premium. This is the price the buyer pays you for the right you're providing them. This premium is yours to keep, regardless of whether the option is exercised or not. So, in effect, writing options can be a way to earn income. However, it's not all rosy. Writing options involves a higher level of risk. Why? Because you, as the writer, are obligated to buy or sell the underlying asset if the option is exercised. That means if the market doesn't move in your favor, you could end up buying or selling an asset at an unfavorable price, and that could lead to significant losses. So, while writing options can be a lucrative strategy, it's not without its pitfalls. It requires a deep understanding of the market and a keen eye on the market trends. It's essential to thoroughly assess the risk-reward scenario before diving into writing options. Writing options can be a great way to generate income, but remember, it comes with its own set of risks. Like all investment strategies, options trading comes with its own set of opportunities and risks. Now let's talk about the opportunities that options trading presents. Firstly, it allows for hedging. This is a strategy used to offset potential losses that may be incurred by other investments. Simply put, you can think of hedging as a form of insurance for your portfolio. Another opportunity is the potential to generate income. When you write or sell an option, you receive a premium from the buyer. This premium can serve as a steady income stream, especially when used in conjunction with other investment strategies. Options trading also allows for speculation on market movements. This means you can benefit from the rise or fall of a stock's price without actually owning the stock. If your prediction is correct, the potential profits can be substantial. However, it's important to remember that with great potential comes great risk. One risk in options trading is the possibility of losing your entire investment. If the market doesn't move in the direction you predicted, the options you bought may become worthless by their expiration date. The market for options is also complex. It requires a deep understanding of financial markets and investment strategies. Without proper knowledge and experience, it can be easy to make costly mistakes. Another risk lies in the volatility of options. Options prices can fluctuate rapidly and unpredictably, especially as the expiration date approaches. This can lead to sudden and significant losses. Finally, writing options, while it can generate income, also carries risks. If the market moves against you, your potential losses can be unlimited. This is because you're obligated to buy or sell the underlying stock at the strike price if the option is exercised. In conclusion, options trading presents a myriad of opportunities from hedging and income generation to speculative profits. However, it's not without its risks. The potential for losses, the complexity of the market, and the inherent volatility all demand careful consideration. Options trading is full of opportunities, but it's crucial to understand the risks and manage them effectively. We've covered a lot about options trading. Let's quickly recap. We started off by defining options as contracts that give the buyer the right, but not the obligation, to buy or sell an asset at a specified price within a certain period. We then delved into the core concepts of calls and puts. A call gives the holder the right to buy an asset, while a put gives the holder the right to sell an asset. Next, we explored the art of writing options, which involves selling options you don't already own. This strategy can be profitable, but it's not without its risks. We emphasized the importance of understanding these risks and managing them effectively. So there you have it, a beginner's guide to the exciting world of options trading. Remember, options trading can be complex, but with the right knowledge and strategy, it can be a powerful tool in your trading arsenal.